Well, I really appreciate the time to get caught up today. And as we said at the beginning, I'd love to just have this be conversational. I apologize for the voice. I was out in the West Coast for the last week and somehow, airplanes or otherwise. So I've got my giant cup of tea and will do my best not to sound too raspy through the presentation. And again, please please interrupt, please ask questions. I've got a fair amount in here on the topic, so I'm not going to try to read everything, but hopefully you'll get the sense of it, and we can take the conversation from there. So just quickly on ABS Capital, and for folks who've been around the financial industry, we spun out of Alex. Brown and Sons back in 1990. I'm here in Baltimore, and so that's the ABS Capital was the old Alex. Brown and Sons Capital. Since that time, we've really stuck to fund sizes of kind of $300 to $500 million. We haven't tried to grow like other firms as far as the fund size. We just feel like that keeps us in a nice sweet spot. We're currently finishing up investing Fund 8. We'll probably be kicking off fundraising Fund 9, early next year. Our investments are typically $10 to $25 million, and we're very flexible around how we think about that capital. So it's often, which I'll get into, supporting primary and organic growth. So it's primary proceeds going in, supporting organic growth and really helping refine that. We're very comfortable understanding that at the stage we're getting involved with companies, that there's some founder owner risk mitigation that can be important. Many times folks are thinking about the world as, do I invest one more dollar into my company, or one more dollar into my kid's education fund? So, we're comfortable trying to make that work so everyone's in the same risk orientation as we begin the journey together. And then very often we end up being a minority ownership investor, so pretty significant partner, but often 15 to 40% ownership of a business, and really working from that minority partner to help professionalize the business as you carry it forward. So that's a framework just of where we come at the world. And we call ourselves growth equity. Going back to 1990, we were probably talking about this before that really became a formal category. You often had the venture capital world, down at the startup side, and the PE world. On the startup side, it was, how do we get great ideas going? On the PE side, very often there was a heavy dose of financial engineering. We're getting involved with companies when what we call it is kind of the early execution phase. And for a number of years, we did a kind of not bright line proxy of that, it being 10 million of revenue. But the nature of technology and the ability to outsource on a variable basis now, building technology and operations, et cetera, that revenue mark has become a little less clear. And so for us, it is, how do you have a business that is getting into a flywheel that's beginning to turn? You've gotten proven market acceptance of your product, but you have a long growth and professionalization of the organization ahead. And so that's how we think about early execution phase, not taking, earlier venture risk to the extent possible. So many of our companies typically are tech-enabled or software businesses. Often they're B2B, business-to-business companies. So, my wife will ask me, or people will ask me, well, tell me some of the companies you're involved in, and I can list off names, and you get that blank stare because no one really has heard of them because they're operating often behind the scenes. But it's really around kind of 6 critical sectors of the economy: financial technology, healthcare, human capital management, and education tech. And a lot of people think about those 2 industries as separate. We've kind of come at it from the corporate employer world. So the overlap of kind of ed and human capital management is combined into that sector. Marketing and e-commerce, security and compliance, and then smart infrastructure. One of our newer partners has been building that area out. And we're really looking for companies that are often founder owned, and it's a chance for us to really bring partner and skill sets that we've had over our 140 some portfolio companies to help that founder owner while they grow their business, look around the corner, avoid the pitfalls that they might have, and really make that a smooth transition while providing capital to help them invest in the organization. Because often scalability, is taking a how do I not spend, how do I think about my next marginal dollar? Let's get you the money that you can invest quickly in that infrastructure of your organization and your sales and marketing. So ultimately you're coming out at a faster clip. Around the selection criteria, for us, it's because we're backing organic growth. A lot of it is around that addressable market and, what is going to be the opportunity, and both today and in the future. And, a lot of people talk about total addressable market. You'll see banker decks that talk about the $40 billion addressable market. Well, that's all nice, but many times we're dealing with pretty small companies, right? So it's really, what's the addressable market today for the products you have? And then how do we work together to understand, if you're thinking about market or product extensions, what might that mean? And do we have ultimately enough runway? I don't think there's a magic number there, but the idea is that you can be too small. And so if you're getting into a situation where, an addressable market is $300 million, that's a very sizable market for an individual company that may be a founder owner that wants to go play in that space. As institutional investors, it becomes a little more difficult because we have to think both about what's the runway for our 3 to 5 year plus hold, and then how is that next owner going to think about that hold. And so it may not matter as much if a strategic is buying the company, because they may already be in the business. But if for some reason you were thinking that this might be a platform for another sponsor type company like ourselves, they're going to be asking themselves the same question, which is, so what's my hold look like in my runway? And that TAM then does make a difference to them. If we've been successful in capture 25% of a market, ultimately you're going to have different dynamics in that next 3 to 5 year plus hold going forward. As I mentioned earlier, we're getting.
Sorry, I got a question in the chat. So are you guys focused on just revenue numbers, or does EBITDA come into play at all for selection?
Yeah, it's a great question. And I'll actually skip to number 3 here, the profitable unit economics. So often our businesses that when we get involved either don't have EBITDA, or our investment is going to push them into a J curve of burn. So if you have a founder owner business, many may be running at that break even, making a little bit of money, but they're being constrained because they have a good idea, they have a good product, and they want to accelerate that, and they don't have the capital to get going. So for us, we are thinking about that future state. If you had the capital and we pursued these strategies towards a North Star, what do we think the business collectively, what do we think the business can achieve? What are going to be the headwinds? What are going to be the tailwinds? What do we need to get done? And then how do we think about valuation metrics of what the market might attribute to that business if we're successful? And so today, when we're getting involved, there will be some revenue number that we can measure against as one input. But for us, it's around profitable unit economics. So do we understand as an organization, what those building blocks are, even if below that gross margin line, operating expenses, or because we have infrastructure, et cetera, we're running a negative EBITDA. Do we believe that if we put enough of those profitable gross margin building blocks together, we should have a profitable business down the road, or a business that is able to be profitable if we're not choosing instead to continue to invest in growth because that's continuing to work? Hopefully that addresses that question.
Yeah, absolutely.
And let's see, I'm just skimming through the list here. The actionable data assets has been an interesting conversation. We have portfolio companies, some of which are building data models. So their goal is, I'm collecting either proprietary or third party or a combination of data, and I'm selling that as a product. A lot of the companies I personally work with, it's a step back from that. It's, how are we using data to better engage our customers, and make them stickier over time, delivering some type of benchmarking, or even using data internally to how are we making better decisions. And I'll get into some of that a little later. We are trying to back teams with domain expertise. For us, as I mentioned, we have 6 sectors. I've spent 25, 30 years in healthcare now. I hope I can't say or explain someone's business better than they can, but I should be able to bring a lot of resources to bear and understanding of the marketplace that they're interacting with. But I really need someone sitting in that seat who understands it also, because I can't be driving that from the board level. It needs to be us backing someone who's going to know the nuances and the ways to best advance their business in their particular industry. And then we talked about this a little bit related to TAM, is we don't have to have expanded, kind of next revenue vectors, but it is this idea of, are we trapped within a single solution, or how are we going to find adjacent solutions over time that will help us expand the market we can go after? And as I get into some examples in a little bit, maybe that'll become more clear. And then I'll touch on what this the concept of the frameworks that we talk about internally. I won't spend a lot of time on this, but we are thematic investors. We're not trying to set 5 or 10 subsectors and saying, in 2023, we have to have a company in this space. It is something where we have theses and themes that are helping define, where are the drivers in the economy, and where do we want to spend our time looking for opportunities and building our networks or enhancing our networks. And it does help us when we get to things where you say, well, that's an interesting company. Someone's probably going to make money there, but does that really fit with how we were thinking about the themes that we wanted to get invested behind? Is it really for us? And so it's been a good way to both help refine the sourcing that we're going after, but also as a checkpoint as we're thinking about opportunities. And we've already done the work on the sectors and the themes to say, when we do see something, we're able to act, fairly quickly, because we've spent the time understanding why it would be exciting to be invested behind those themes that we've spent the effort putting together.
Hey, Cal, so you had mentioned that, a lot of the companies that you work with kind of fly under the radar. They're not very well known. So how do you source your opportunities with that being the case? How do you find them?
I'll put in 2 broad buckets. There's what people say, proprietary. I don't really believe there's really anything that's proprietary. It's stuff that is, I'll call it non-banked. And then there's, the whole world of investment banked or other represented, third-party represented businesses. We've, myself and each of our partners have spent a long time in our respective industries, building relationships, working with board members, finding ways to get how we can work with folks out into the marketplace. So we are of mind when an accounting firm or a law firm or a good friend says, hey, do you know someone who might be interested in this type of capital raise? So we're being very proactive in going out and look, I'm cold calling companies. We like to have that from the partner level, because I can have an engaging conversation around their business, right? I'm not calling in saying, so tell me about your revenue and are you raising capital soon? It's really, hey, I'd like to understand your business model, because we've got something that's maybe adjacent to that, and you can get into a much different conversation. And that often leads to, hey, you know what, we weren't really thinking about raising capital, but if something like this might work, that would be great. There's a middle zone there where I'll call it investment bank light. There is some advisor or some representative, but they're not running a broad, kind of try to maximize price term type of process. It's, hey, we know 5 really good investors in healthcare where we think you fit, and we're going to go give you the time to spend with each of those, because you, founder owner, need to make that same selection back, right? I mean, so it's not because we're coming in as minority partners, it really is a partnership. Like, I want to spend time up front with the founder CEO, with the team. Where are we aligned in our thinking about what the opportunity is here? What's going to get in our way? What are we going to try to accomplish? If we can get that qualitative stuff figured out, which takes time, the quantitative stuff will get itself figured out too, because we'll be talking the same language as we look forward about what do we mutually agree success looks like. And so if we kind of mutually agree that we're going to try to get to that point and the steps that we're going to get to that point, then we can figure out, what's a financial structure that's relevant to that. So I think in Fund 8, the one that we're finishing up now, maybe there was one, but I don't think there was any that came from a true broadly distributed investment banking process. Everything was either kind of a light advisor relationship or, the opportunity to connect directly with a firm. That doesn't mean they're not talking to other firms. I don't think, as I said at the beginning, I don't think anything is proprietary, but it's not, you have a chance to have and manage the dialogue in the way that makes sense for more people, not, and next week you have to have an IOI, and next week you have to have your diligence done, and then go. Though we're just not built for that type of process. So again, I won't spend a lot of time here, but the idea is we are trying to come in and help you avoid the pitfalls and bring additional experience to bear around the organization. And the idea is, how do we better get that strategy and growth organization to get you the extra leg up, as well as having the operations within the organization be able to handle that acceleration in growth. I touched a little bit on the value creation frameworks. This is how we think about how we would work with companies going forward. We do not come in as a playbook. There are firms out there that have been very successful and kind of, here you go, you're working for us, here's 200 pages, go do this. These are very bespoke situations for our companies. Every single company is different, but I think we have, 5 or so areas that we say, these are the ways that we can really help you, and you can help you be a more professional and more scalable organization. The first one there is one that I feel like drives a lot of this is team and governance. You got to get the right team, the right people in the right seats, and have an organization that's ready to accept that it's not, a founder CEO making the decisions anymore. There is a board. They are there as a resource for the CEO. They are there to help guide the organization. And I'd say, of all the things here, going back to all our successes and lack thereof, it's really probably a lot of that could be pointed back to, did we get that team and governance and alignment right early in our investment? I've talked a little bit about the data-driven strategies. This can be, again, just think about the organization as, how can I use data to better perform? Excuse me one second. Excuse me. How do I use data to better perform in my organization? And maybe I can turn that into an asset, but at least there's ways that I'm using data to make better decisions. I'll give an example of the technology acceleration in a little bit with one of the companies. The go-to-market strategy, this is a lot of where we pay attention. Do we have the right channels that we're going to? How are we thinking about compensation strategies to drive performance? Are we getting that? Excuse me one second. I apologize. Are we getting the right connectivity between marketing and sales working, that everyone's being as efficient as they can to keep that acceleration going? But then again, thinking about, do we have the operations to support that advanced sales and marketing effort? And then market expansion, how do you think about ways that in the future we could expand the opportunity for the organization? Give me one second, I apologize. So all to say, we're trying to take kind of rule of 20 companies and make them rule of 40. And so for folks who are familiar with that concept, it's really taking the company's revenue growth rate and their profitability margin. And so for us, we can have a company that's still burning capital, but if we can get a 25, 30% grower being able to handle 40 to 50% growth for a period of time, knowing that we have profitable unit economics and we can get to positive EBITDA if we needed to, that's fine. Others may not be growing more than mid-20s, but if that's the case, do we have the organization thinking about, when are we going to make money, or at least have the data to make the right decision in the trade-offs of, am I putting my next marginal dollar into sales, or am I putting it somewhere else in the organization to know that I can be getting myself to breathing oxygen and ultimately generating capital out of the business. So I'm going to just go through a couple of examples of some of my portfolio companies that maybe capture some of these themes. The first one here, Audacious Inquiry, we sold this business earlier this year. It was a healthcare data business. They were facilitating data transmission to support improved care coordination. So a simple example, but just to come across with it, you're a provider, you have 5,000 patients. Right now, the healthcare system saying, hey, there's carrots and sticks for you to take certain activities with your members or with your patients when something's happened to them, they get discharged from a hospital, et cetera. Traditional methods where you would query in to a giant database, the original health information exchanges, who would pull all this information together. And then my wife, who I mentioned, at Hershey Medical School, she'd go in and she'd type in a patient's name, trying to get some specific information, and 86 pages of gobbledygook would get put back to her, and that wasn't very helpful. Audacious, set up rules and matching. So now as a provider, I could say, here's my 5,000 patients. You tell me when something's happened that I want to know. So I want to know, did someone get admitted to the hospital? Did someone go seek protected class drugs more than one time a month at an ER, et cetera, et cetera. So it was really a push of that information. I saw a chat button show up, so I'll pause there before I get far on. I don't know if I'm able to click.
Yeah, so that's so Christina asks, how important is building strong organizational systems that can scale in this process? Is it all EBITDA, or is there value to having an HCM system or other operating systems?
It's a great question, and I would say it's absolutely having that fine-tuned infrastructure is important. So this is actually one of the big conversations we have with entrepreneurs is there are dollars and costs that you're going to have on an annualized basis that are not revenue generating. And that is having the right systems, the right compliance. You're going to have roles that are looking internal to the organization that look like cost centers. They ultimately are driving significant value enhancement because people can look at the organization and say that is a stable, lasting, able to build on top of organization. So for us, a lot of it is making sure we're going, area by area through the organization. Do we have the right systems? Do we have the right teams? Have we spent the right or put the right checks and balances in there that we know as this business continues to scale, or we even enhance that growth rate, that everything underneath the package is working? Because when we're selling that business, we've gotten invested when the business was 8 to 20 million of revenue, and then we're exiting when it's 60, 80, 100 plus million of revenue. That's a very different organization, and that's one that takes a lot of you can't get to that point if you don't have all the pieces invested in along the way at the same level, and believe that I'm not going to have something break if I'm going to continue to carry the business forward. So I think having all those systems and teams and what, again, these entrepreneurs often say, well, why do I want to invest in a CISO? Well, let me explain how that risk diversification or risk protection is going to help you down the road in value creation.
So, hey, Cal, so along those same lines, one of the things that I see when I'm working with business owners of this size is along those lines of risk. A lot of them have not thought about themselves and taking care of them and their family should something happen. So when you guys come in as an owner, even a minority owner, do you mandate buy-sell agreements be in place? And are you helping that owner with any sort of estate planning for themselves and their families? God forbid, they get hit by that proverbial bus, everyone's protected.
It's a great question. We make sure people are aware of that. We don't kind of cross the line into let us give you a lot of strategies. I mean, we come with the organization hat on. So I mentioned early on, about our capital being, flexible between primary and secondary. So, that is usually a risk diversification measure. We're providing you $2 or $3 million to, pay off the mortgage and get the 529 funded or whatever else it is. So you can come to work every day, not worried about that. I'm not looking to have you go buy an island down in the Caribbean because I want you on the team, but we understand that there's, demands there from a risk perspective. We don't often have a situation where we have a key man risk, but certainly I think Audacious was one of those examples where we did, and we're usually handling that through some type of key man policy, giving us enough runway to make sure we could get a leader in there if we needed to. And we're very quickly with the company, from the board level, talking about succession plans or redundancies around the organization. But we're not getting involved with businesses that are typically so early and so key man, key woman focused because that's usually getting a little bit more now on the venture side, because that means you haven't really necessarily built out some semblance of a team and you're kind of getting that product in the market and beginning to grow. We certainly have estate planning and wealth management relationships that we will suggest, hey, when you're at the beginning of this journey, these are important things to think about, and here's names you may want to talk to, but that's about the extent of where we go. Otherwise, we're coming at it from the company lens. So on Audacious, this was a business that was a very services heavy business. They were doing a lot of consulting and managed tech, and they had this opportunity as they were building connectivity among their payer and provider partners to start to think about, could we layer repeatable kind of SaaS offerings, software as a service offerings, or other recurring offerings on top of this connectivity network. And that's really what we invested behind. We talk about 2 million of SaaS at time of investment. We talk about 2 million of SaaS. The CEO will readily admit that was zero. I mean, it was really an idea, but they were kind of talking to us of, hey, we've got something that kind of looks like it's a couple million, but there really was not a recurring revenue here. But there was certainly an opportunity. They felt to create one. And it was a very low gross margin business at the time. I think a lot of that was they were really good people. And so when they got involved with these big projects, there was scope creep. There was, oh yeah, we'll do that for you, don't worry. And people weren't looking at project level profitability. And you had a services organization, not really a technology organization yet. So during our time, we invested at the end of 2017. A lot of our effort was working with the company of how do we get this organization thinking about itself as a technology organization. Let's not lose what's been successful, but let's really focus on this SaaS opportunity going forward. And let's also be very careful looking at the data, like get down by contracts, get down by regions, get down by customers, understand what's working and not working. Because if we don't, once we understand that, we can improve it. But if we can't understand that, if you can't measure, you can't manage. And so, we ended up having both of those work, very well. We ultimately sold this business, as I said earlier this year, to a strategic for about 5 times our investment. The founder owner still owned a significant amount of money or of the company, generational wealth created there. And so some of the activities, it was pretty basic stuff, but for the founder owner, it was a big deal. Right? This was his company for his and his partner's company for 15 plus years when we got invested. And it was one where they were growing okay, and they were making money, and they were able to kind of every next year, how do we do a little bit more? Coming in around the team and governance, getting a board together. How do you think about independent directors? Not people separate from me. How do you think about people who are going to be useful to you, CEO? How do you think about now, what are the decisions you want to make? And you don't just make them. We need to come back to someone to talk about that. How do you get the right leadership team in place, the right people wearing the right hats? Some will be scalable through the next part of this journey, some won't. How do you get the right incentive plans in place to really drive the behavior that you're looking for? In this organization, one of the big ones was, how do you think about technology development? They smartly were going down the road of, hey, my customer wants this, so they're willing to help fund that, so I'm going to go build that. And that's a good way to make sure you're making a little bit of money along the way, and you kind of have a customer funded technology program. That is a difficult way to scale a technology organization. You need to be thinking about, I'm in control of what does my tech roadmap look like? What do I want to develop? Certainly, I need to get my customer input, but ultimately, I need to have a technology that I am selling to the marketplace, not customers pulling me in every different direction about what's their priority. And that takes a different leadership hat, takes a different investment style or investment plan. And that's really what led us to continuing to fund the company and bring in some very healthcare-oriented partners around a follow-on capital raise. Is now that we've thought that we want to be a SaaS business, now that we know what investment it's going to take into that technology to achieve it, we now have our North Star and our plan for the next 3 to 4 years. We need to go fund it. And, we ended up making all that decision in 2020 when no one knew where the world was going to end up. And so that all worked well, and having that capital come in and the flexibility, allowed the company to continue to perform through rough waters, and then ultimately led to a great outcome for everyone. I'll go through this one quickly too, but it talks a little bit about the themes. We had a business here in Baltimore called Connect Your Care. They were one of the ultimately where they got was one of the last independent of scale providers of consumer-directed healthcare accounts. So health savings accounts, flexible spending accounts, health retirement accounts, et cetera. They did all the management of that. They were an administrator. They were an administrator that owned their own technology. And that's why we were comfortable working with the business at the beginning. Was you weren't just a third-party administrator. You actually had something we could hang our hat on, we hoped, of value in the fact that you owned your technology core. So we had what we felt were very good tailwinds behind this business. We were unsure of what this business was going to look like through Obamacare going back 12 some years. And when ultimately these accounts stayed in place, that's when we had the comfort to say, okay, we think there should be very good consumer tailwinds in these accounts for the next, some number of years. Let's go try to find an opportunity. We were well aware of Connect Your Care. They were here in town. It was a team we had known before. We had started to talk to the public company that owned them to try to find a way to, release this company that was kind of buried in big corporate infrastructure, to let them really grow like a growth company, have an opportunity back to the public parent, have an opportunity for the team to really generate, an exciting business and wealth for the team. And that was, those were long and frustrating conversations, with ultimately culminated in the public company decided to merge with another public company. And they said, okay, we're time to clean house. And because of the relationship we had built, we were ultimately the kind of the one private equity or growth equity firm they were talking to. And then there was a handful of strategics that I think the strategic thought it was just going to get sold off to, but ultimately our relationship there made a big difference in what the team wanted to get done. Again, we were in this a number of years, eight years maybe. Fully upgraded the team over that time, rebuilt the sales and marketing organization, really oriented the business about being a technology business. But a key here, when I talked earlier about revenue or market expansion, was they were still an administrator. And the juice, the value in this industry was quickly becoming who controlled the assets. And so as these health savings accounts grew larger and larger, there were banks who used to be partners that were now becoming competitors. There were much larger companies that had assets that they could earn enough money on that they could give away the administrator piece of it for a much reduced cost, or even by the end, almost free. In fact, one very large public money manager, when we were nearing exit, was starting to pay employers or their employees. They said, we will pre-fund the account with $500 just with the goal of getting the asset management relationship. So we had gone into this knowing that that was going to be an issue, trying to get the organization to a point where they could be a fiduciary for those assets. But being a fiduciary, and in this case, a designation of a non-bank trustee, has organizational implications. And so, to an earlier question, how important is it that you have the systems and the compliance and the security, around that organization that's auditable? We had to be in that place to be able to get this designation, and that took time and a lot of effort. But once we had that designation, we now had a little bit more control of our destiny, because we could start to control the direction of the couple $2 billion of assets, which was growing quickly, and start to say, okay, now we're not beholden to a bank partner. We can actually say we are going to place those assets where we choose at our bank partners. And ultimately that ended up being about a $440 million sale, kind of 8 times our invested capital. I think it was actually probably the largest, and maybe still the largest M&A exit our firm has had. We've had some IPOs that have been larger, but you think about this journey over 8 years, it's hard to think that at the end you would have even recognized the company that we had invested in, or would have at the beginning ever thought we could have gotten to where we did. And it's really those kinds of partnerships along the way with the team and the company, and believing you got the right tailwinds behind the opportunity that can create, great outcomes. I'll take a pause here because I see some chat showing up.
Yeah, we've got 3 in the chats. One, when you guys exit, do you ever keep residual equity, or is it all out?
We're flexible to either. We don't live in the world of thinking that we're going to build to do a recap with a bigger sponsor. We've certainly done that. We think that's a good way to stay involved with an organization. Often, we're building a business where we're doing well enough in a market that a strategic or an adjacent player says, I need to own that business. And if you can get someone from that ilk looking at your business, it's a lot harder to get their organization around it. But if strategically it makes sense, very often, they'll pay a better value for it. So I think if it goes a strategic angle, which again, if we're building businesses the right way, we should have interest there. That's usually for us a full exit, because strategic doesn't really want us hanging around it. It's, do something around a larger organization when you tuck it in. If we have sponsors come in, a larger private equity firm, oftentimes it helps their investment thesis if we're staying in. And if we've done our job, we've built a business that should create, ongoing and lasting value. And in those cases, we're happy and excited to keep a stake in the business going forward. Ultimately, we're just fiduciaries for our limited partners, though, right? So we do live in 10-year funds. There's some flexibility to, how do you extend those funds? But ultimately, we need to get money back to our limited partners, and next investors understand that also.
Good. How do you discern between vaporware and a real business?
I think that's the time you're spending up front. It's interesting. Sometimes you can even get it without having done any diligence and just interacting with the team, and you start to get a sense of how is this individual, or how are these people speaking to me? How much are they trying to sell me? When we do our diligence before we make an investment, I'd say that there's probably three areas, but the two key ones, we're doing financial work. It's not necessarily a full quality of earnings, but I'd call it a quality of earnings light. Do we have a financial organization that has capable people managing it? Are they asking the right questions? Are they able to close the books? Are we allocating the gross margin correctly? So when we're making decisions, are we all on the same page there? We do a technology assessment. We have a couple firms that we work with to really get in and help us understand what do we have, and as much on that, what's the roadmap that we can be working with the company on. So we're very transparent with the reports we get back. This isn't us tucking it off in a drawer. It's, hey, we're looking to third-party experts here to help us collectively know how do we want to prioritize our investments around the technology opportunity going forward. And we as a firm are not in the business of thinking that when it comes to technology that we're going to go in and be rewriting version 1 to version 2, knowing that that's something we got to do when we get in there. There's always going to be investment that needs to be made. I say all that, and I've been subject to getting beaten up by that too, where it's like, oh my gosh, this is much less scalable than we or our advisors thought. But at least there's enough there that there's a real solution that has real value that should be able to be sold, but sometimes there's more technical debt than you might expect. And then the third area we do a lot of diligence around is the team. We don't do it on every investment, but very often, we'll have a group, GH Smart, Summit, others come in and talk to that founder owner. And the idea here is not, hey, this is a go, no go, personality assessment. It's, we got to have communication right going forward. Like, we're coming in as partners, so we need to know how you make decision making, so we can best interact with you, and how we share information to make sure we've got those communication paths open. So it's not a, come back with, oh my gosh, you've got a, psycho on your hands you're gonna have to deal with. We would have figured that out already. It's more, hey, you've got a way you think about the world and how you think about building a team. We're going to come in with views about that also. So how do we best make sure we understand how people think and communicate to make that an efficient process going forward?
Curious how you determine Connect Your Care's proprietary technology had a competitive advantage in the market versus something derivative or even inferior to what other companies were using.
I'd say at the beginning, they didn't. But it was also early days still in building that out. There were a few businesses that had been bought by other strategics. There were some other strategics that were building that capability. We did know that there was good user alignment of the business. So I'd say CYC had the front end, when we got invested, had the front end better than the back end. And I think the lift on the back end was more than we expected, but we also realized that was an area that made a lot of sense to put the investment in, because A, we wanted to have the business thought of as a technology business, and B, if we didn't have that, we weren't going to be able to go get this non-bank trustee license. So we're not getting involved in things. I think it's very unusual to think that you're getting involved in something that is not replicable or doesn't have other solutions in the marketplace. So that comes down to, how do we think about our strategic plan going forward and really tighten our priorities towards what we collectively agree is the North Star of success, and go pursue that quickly? Because if we are making sure that we are moving at pace, making the right investments in the organization, we should be able to be doing better for our customers. And does that mean we win 100% of the time? Absolutely not. But it does mean we should be a favorable choice in the marketplace as a partner to work with. And as you get bigger and bigger, your customer is going to ask more and more about what's under the hood and what's in that organization. And that's why we, take such focus in how do we build out the entire organization, not just having a sales engine, pumping along.
I got a few more. Do you want to continue with your presentation or do you want to...
No, this is good.
Okay. Is there a target internal rate of return or a margin on invested capital you look for going into a deal?
Yeah, I'd say broadly defined, we think about it as, can we think that we can be getting 3 times our investment? And, we're not trying to structure a security, obviously that's not guaranteed, but this goes back to working with the team, right? Is, hey, if a lot of things go right and some don't, the organization should look like this with these kinds of metrics. And, reasonable people would say at that point, some number of years down the road, this would be a valuation range. And, do we think that that can kind of get us to 3 times our money? For us, the big one is don't lose money. Like, so that we come at it a little bit with the whole portfolio theory. If we had a lot of investments that kind of returned 2 to 4 times capital and you didn't have any capital loss, that's an excellent fund. If you start having capital loss, you need to have, some outsized performers to make up what can end up being pretty big holes. So I think we go into it saying, how do we feel like we've got enough value or something we can hang our hat on in the organization to know that if we have to get out, we're gonna be able to get our money out. Hopefully, it doesn't always happen, but let's have high confidence around that, or at least strategies to have that happen. And then if we can get it right, maybe we end up getting to the plus or minus 3 times, or you can get it right and you can get the 5 times, the 8 times, the 20 times that we've had in the past. We're not trying to underwrite to that, but I think those are testaments not to, we were backing some unicorns that the market got us there. Almost all the time that was because the business got us there. And you might have had favorable market conditions, but it wasn't, we had something that was quasi good, and then the market was going cuckoo and we were able to exit for a huge outcome. It was, you've got a leading business in your industry, and that's created value.
Given the uncertainty of previous and future business environments, what have the failures taught your team about what not to do or what red flags to look for?
So that one may be, let me see if I have this here in the next one. So this isn't going to exactly address that, so I'm happy to answer any further questions. But I was thinking on the plane back yesterday, so what are some of the things, what are the culprits that get us off track? And there's probably a lot more than this, but these are the ones that kind of popped into my mind. We are going into this as a partnership, and we are expecting everyone to be wearing a company hat. So from my side, I'm a director and I'm a shareholder. And I make it very clear to the company that should those ever come in conflict, I am wearing the company hat. I'm wearing the director hat. And there will be someone else in my organization that can speak from the shareholder side of ABS Capital as a shareholder. And those may not always align. 99.9% of the time they do. But if things aren't going well, or there's real challenge in the organization, there may be times where as a director, I say the company should pursue this. An ABS Capital shareholder, as a shareholder, says, looking out for us as a shareholder, we should do that. And I make it very clear to the company, however you want me to have it divided up, I'll recuse myself from internal discussions. I promise you no information that shouldn't be shared with ABS Capital is being shared, but I am wearing the company hat, and I expect you to do that too. And so we've had situations where there are good decisions for the company that maybe for the personal financial outcome of the founder owner, because they own a meaningful stake, aren't as desirable. And that becomes very frustrating when you say you are the leader and the CEO of this organization, your job is to be looking out for the company and the organization, and you are putting personal self-interest ahead of that, which may lead us to either a higher risk or a suboptimal outcome. So that is one that drives me nuts. Intuition instead of data. I know my industry. I've been in this industry 20 years, and I'm telling you, this is how it is. Okay, well, how do we know? And so for me, I like to come at it as what is the data that we're looking to? What are the KPIs? How do we judge performance? Because, hey, I'm just sitting here at the board level. I'm not living it day to day. I'm not 20 years in your particular industry. So how do we know that we're keeping things on track? How do we know, and what's the framework of if we're going to invest behind a new opportunity? Let's agree up front. What do we think the outcome is going to be? What do we think the results should be? And then how are we going to measure and monitor that over some period of time to know if it's working or not? Another one here would be the just one more quarter. It feels like it's going okay. I mean, we've had some bumps in the road, but just one more quarter, a little bit more money, and it's going to work. And ultimately, that's if the data's saying it's not working, or then either we're approaching it wrong, or it's not a good idea. And let's all agree that that's the case, and not keep running down a road because we feel like it should be the right answer. Many of the organizations we get involved in have very capable people, but they're just understaffed, or I should say overstressed, but they're wearing too many hats. So you've got someone who can do the 6 things they're tasked with, but they can't do them all at the same time well. And so it's really founder, CEO, how do we make sure, and it's going to take money, that you identify the best capabilities of folks on your teams and get them into the role that they get to wake up every day and think about that. And that means that there may be responsibilities that get shedded off to other people who can then wake up every day and think about that as their priority, because it holds the organization back. And it's hard because it takes money, and people say, you're talking about another $1 million of annualized cost to my organization, and it's not all revenue generating. You say, yeah, but you can't scale an organization unless you have people pushing forward each of these areas, because if someone is going to prioritize it in one way, it's my list. I've got things on my list from a year ago I should have gotten to, and I haven't, because I don't prioritize it, but it needs to get done. So should I be doing all that? No, probably someone else should be hiving that off from me, and they should be waking up every day and thinking about that. The incentives, not aligned with desired goals. Are you, in each of your departments of your organization, can everyone say what success looks like? And then do they feel like their incentives are aligned around that? Because, we've had plenty of companies when we help establish kind of organizational or corporate incentive programs, bonus programs and the like. And it's amazing to me how you can somehow get 100% bonus, and you wonder, do we really create value around the organization? And so it's, how do we get those in a simple, clear way to say, if we get A, B, and C done, we've created value, we've moved forward our goals, and everyone can sing that same tune within it. And if you start adding too many MBOs or too many metrics or otherwise, somehow, success can be achieved, but the organization hasn't been moved forward. Poor communication, selling your partner. I mean, obviously the communication aspect, we're partners trying to get in here, but we're already owners now. Well, I guess there's 2 ways to think about it. One, before we're an owner, you're an entrepreneur. I think inherently you have to be optimistic, and you want to be selling and thinking about the glass half full, and that's great. That's why we want to back you. Let's all be reasonable about what we're trying to achieve. So if you're trying to go maximize the highest price for the greatest, top case opportunity, we probably aren't going to get involved. But if we do, and you miss that, you have not started this partnership off in a great footing. And I can tell you, I'm going to be pretty grumpy at that first board meeting because you sold me. And again, we try to do all our work that's not going to happen, but that's maybe not even a personality, ultimately we should get involved with. But more importantly, once we're invested, these are growth companies. Stuff goes wrong all the time. Like, we get it. We're growth company investors. Like, if I haven't heard back from one of my CEOs about a problem for 2 weeks, we just haven't caught up because something's going on there. And I totally get that. So be open with me, be candid with me. I'm here on your team. We're supposed to be all aligned in our ownership structure and what we're trying to achieve. So let's be productive about these conversations. Let's make sure we're coming up with a good set of ideas. I want you to come forward with recommendations, but let's really be on the same page, because coming and telling me everything's good and then not having it good in the organization, you can't hide it for long. It's going to come out. And then ultimately it's going to reflect very poorly on the person who was creating that situation. And we'll talk about this maybe a little bit, but just restrained flexibility. That could be around the team. Do I not have enough team organization there? It could be, did I try to stretch my capital too far because I didn't want to risk a little bit more dilution? Growth companies go up and down. Everything's moving all the time. Having the flexibility to be able to tack and move and accelerate some area or pull back some area, it's critical, because if you don't have it, you find yourself making suboptimal decisions around the issue that you have. And that means you're not achieving, the goals of the organization, and probably becoming, hurting your competitive stance.
So Cal,
just
go ahead, Andy.
Thanks. Yeah, just around that. I mean, you mentioned you're a minority partner or minority investor typically, and you sort of emphasized, getting the right board in there. But is there specific protections that you look to sort of put in place for when things really are going off the rails, and the founder's not necessarily doing what you want them to do, or you sort of relying on the board process to resolve any issues around that?
It's a great question. So, we do try to protect ourselves through our security, so we do have some protective covenants. A lot of that is pretty big brush stuff. You can't go change the equity structure without our approval. You can't go put a bunch of securities above us or go take out 20 million of debt. So there's a number of things around capital expenditure or lending or structural or changing the business or changing the size of the board, just things that as a shareholder, we'd say that's either changing the opportunity or diluting our claim without protection. Otherwise, a lot of it is from the board level. And that's why it's so important for us to spend the time ahead of making an investment, really understanding, are we on the same page? Is this someone that we can partner with? And is this someone who believes that we can bring value to the situation and get all that alignment, up front and have that dialogue? That's a lot of it. We do have one other protection, which is, having because we're fiduciaries for capital, having a kind of a fair market value exit option. So, that gets set some number of years down the road. I don't think it's ever been called, but it is something that just keeps it fresh in everyone's mind that, at one point we need to be achieving that next transaction. And so we're not just here for fun, going on for, generation after generation. And we had a business like that got negotiated away. This goes back years ago. And it was someone who we thought we did have great alignment around. It was a very good company. And it was a family business. And it was a lot of their family wealth generation. And so we all agreed up front, hey, success looks like this. And we kind of got to there. And we said, okay, well, so, how do we want to think about maybe organizing around that next transaction? Well, I don't know. It seems like we're really doing well. So I think we should keep going further. And we're like, well, we kind of need to get out, but if we're going to call that a couple years and now your make up numbers, your $300 million exit is 500 million and you think you can get there, we can hang on for a little bit longer, but if we get close to that or a couple more years go by, we need to get out. And we got there, and then the 500 million became $1 billion. And so it was like, we have to get ourselves out of this situation. And unfortunately, we had a suboptimal exit of that because we didn't have a right around it. So we ultimately had to go back to the company and say, we need to get bought out. And that buyout was not reflective of the value that our stake was worth, but we didn't have anything else there. So this is one I spend the most time with around the CEO, or if there's a board already in place, is this is not meant to be a gotcha. It is not in 5 years, this is getting pulled. It is that we're all agreeing that, we are not in here for the next 20 years. And so let's all think about what are we trying to get done. As I mentioned with CYC, we were in it for 8 years. I have another business I've been in for 8 years. Some were in for less than that, but it's a forcing mechanism to say, hey, if we're in here and we're having divergent views about what the future looks like, ultimately we do have the ability to get ourselves out. We don't want to have to pull that, but let's all constructively think about what type of transaction would allow you to continue on team and ABS Capital to get, liquidity.
And are you typically the only sort of external investor in your deals, or was there other investors?
That's a great question. I don't know the percentage. There many times we have earlier stage venture firms in there, but I would say they are definitely a stage or two or more earlier than us. So their focus and capabilities and desires of kind of how they interact with an organization are different than ours. And that's natural. I mean, the organizations that we ultimately sell the business to, they have different ways they interact with their organizations, and it's not right or wrong. It's just because the company is more scaled. So many times we actually get called in by those earlier stage investors because we've had success with them in the past, or they know that we're, a rational group around the board and can drive a lot of value, saying, hey, look, we've kind of done what we can do. We want to go raise $15 million. We're going to participate, but it's time for kind of that next level investor to come in here. And then many times it is just a founder owner that we're working with. But they've probably raised friends and family money along the way also. But the idea that, there's been a true A, B, C types of rounds and we're coming in as a crossover D, that's not for us. I mean, that's just a different structure around the company. But we have great relationships with earlier stage investors and think that, those organizations can bring great value to the organization in a different way we can. So we're happy to partner with them. I don't know if that checked through all our 8. I saw an 8 under chat, but I'll move forward here quickly. So one of the things Mick mentioned was, how do you think about this environment? I'm not going to come at it as an economist and talk about, free money and everything else and why we might be here. But just some macro perspectives. Everyone bemoans the market this year. Certainly, our industry has gone to more of a risk-off perspective, at least for a period of time here. Good companies are still commanding attractive values. I think the question now for that fat part of the bell curve of companies is we probably raised money in the last couple of years at valuations that aren't, supportable today. So they've got a lot of, navel looking and internal self-discovery of, do I go ahead and pull the Band-Aid off now because I've got a good strategic plan and I want to be successful? Or do we hope that things get better, which they might or might not? Again, none of us have a crystal ball. I would put in the context of this, though, I just use this one data point here. This is just around HR technology, but I had seen the slide recently, so I wanted to pull it forward. So this is the enterprise value against an LTM revenue multiple for a number of the public players in an industry, and that mix of public players, has changed a little bit over time. And this is what I've tried to stress to a lot of companies is, if you're thinking about a business that's getting, 6 to 8 times revenue multiples, or an industry on average for a number of years there that was kind of getting 6 to 8 times. When I started in banking, that's what I was talking about as an EBITDA multiple, right? And now you're getting revenue multiples there, and it was pretty consistent. And then you hit COVID, right? And you had business models that were efficient business models that went through the roof. You had the Pelotons, everyone's going to stay home, go through the roof. You had free money, maybe distorted investment strategies. And this is from back in early October, so I don't know exactly where it is, but I'm guessing that if we looked right now, that current number is probably closer back to that median again. I think, you'll have valuation, increases and decreases. What we saw over the last couple of years was a pretty unique distortion. And so I've tried to say to our companies, some who, it could have been, it could have been, but I'm not waiting for it to come back again. So, we were all talking about setting our strategy back there and, early 2018, and I look at the industry multiples and we're kind of at the same place, right? So the value creation really comes back to, what have we been able to do as a board and as a team, and darn it, would have been nice to capitalize on the market, but if we weren't ready, we weren't ready. And that is the case. But I think it's a good different way to look at it. And as you consider moving forward, don't get too hung up on that recent past. So recession, I have no idea. I'm usually a glass half empty guy, so I probably have a different view than maybe others. I just pulled this off of a little Bloomberg thing back in mid-October. Chance of recession hits 100, near certainty, and then in the same one, not inevitable. So I don't know, and this is really where it comes back to flexibility. Popped up this cartoon too. There's a lot of things that suggest that we probably are heading into a recession, but does that mean we have economic turmoil, or is it just defined as an economic recession? I think the key here is people making sure that what strategies do I need to put in place to continue to maximize my flexibility and be able to pursue that strategic North Star that we've been working towards. So no one has a crystal ball, so I'll get in these discussions at the board, and people will say, yeah, but because of data point A and B, Q2 next year is going to be much better and we'll raise capital then. And I was like, I don't know how you know that. We don't know that. So let's not, hope isn't a strategy. The other one is, well, I don't want to, we don't want to take the dilution right now. It might not be a great time to raise capital. We'll wait. Yeah, I talked about Audacious Inquiry. We raised capital August of 2020. So we had our first COVID bump. We're going to go into the second one. Was I thrilled with the valuation we got? No. It was critical to get that money in-house, so to make sure we could, in an unknown environment, go pursue our strategic plan. And that's why we got the exit we did. And so, taking a different level of dilution than we might have originally thought absolutely paid off to make sure we had that capital flexibility, not knowing, was the world going to immediately get better, or were we going to go into a long, cold winter? Have that action plan in place. What's the first level of cuts or adjustments you might make, and the second level, and the third? Doesn't mean you have to share them broadly, but know what your action steps would be so you can move on them quickly. And those are always going to change, but that's something we do try to work with our leadership teams on, is what would you do in your department if X or Y or Z happen? Like what are we going to do versus kind of, oh my gosh, how do we react? The fourth point here, this is just the idea of a little bit of flexibility, but it's good to make money if you can. It doesn't have to be, maximizing margin, but to the extent you can be building a business around those profitable unit economics to be in control of your own destiny or not be living just to that next financing, you sure sleep a lot better at night. Stay focused on your North Star. I've used that phrase a couple times here. If you've all agreed where to take the business, keep your prioritizations of your activities and your investments against that, because that's where you're going to want to be despite all the noise of the market, around you. And then ultimately, no one knows what's coming next, right? So it's constantly challenging that organizational dialogue. We do strategic offsites, with companies that we have with the board level, and it's thinking, okay, what is our action plan if we have a major, cyber attack on the organization? What is our action plan if, the leadership of our development organization gets hired away? What is the action plan if our, CEO gets hit by the proverbial bus? It can drive you nuts sometimes because you can't know what's coming. But is the market going to go up, go down? Is Putin going to use a tactical nuke? What's that going to mean or not? It's just knowing how flexible is my organization, and do we know what path we'd start to head down given these different external inputs that we can't control. So I think my last one was just conversation time, which we've had good chats along the way, but I'll just stop there and happy to continue to answer any questions.
Yeah, Cal, are you open to follow up after this? And if so, what's the best way to contact you?
Yeah, absolutely. Mick has my email and I think my cell phone number, and be happy to chat with anyone.
Good. No, there's no other questions in the chat. Anybody else have any questions for Cal?
I put them all to sleep. I know how that can be. So
What's typically the minimum amount you look to invest, Cal?
So we come at it a little bit from that portfolio theory. So if we have, $300 to $500 million funds and we want to have good time and company diversification in there, that's how we usually get back to these $10 to $25 million investments. We've done things smaller than 10, with the idea of kind of a toehold or a reason to do that. But if you get too many that are sub 10, you get kind of too much of a portfolio sometimes to manage. We've had a lot of companies that, could be $20 to $30 million types of investments. You've now got a lot of a concentrated risk in some of those investments, and maybe you don't have the diversification across the fund. So ultimately, they aren't bright lines, but we'd like to get in. We'd like to believe that we could continue to support the business going forward with capital without feeling like we have to go to our LPs, because I think kind of like doing a remodel on your house or anything else in life, just whatever you think it's going to cost, add like 25%. It's like no different with growth companies. Like whatever you think is going to happen, just assume you're going to have that much more dilution, or that slower process. It's just the nature of things. So if we're getting in with a 15 to 25 or 15 to $20 million check, we're probably mentally saying, and let's believe we've got another 5 to 7 million to support the business that may or may not be needed. A lot of what, as I mentioned earlier, a lot of what we're doing is backing organic growth. We're not doing buy and build, kind of the PE strategy. I've bought a platform for 100 million, and my goal is to put another 100 million around it by buying a bunch of little pieces. So for us, it's, hey, if things are a little less efficient along the way, either if we need to raise a bigger round of capital because things are going well, or we need to help the company buy a little bit more time, let us at least be able to be there as a supportive party along the way. And so that's why we like to have it be meaningful enough that it's a decent size in the portfolio compared to whatever else we have in there, but not stretching on our tippy toes out of the gate.
And do you invest purely just equity, or do you do combination of debt and equity? Or
we're solely equity. So we do have the ability in unique situations because of company structures to have something that kind of looks like equity, but we're not doing a kind of a more unitranche approach that I think some folks in the market are, which is I could do a portion of my investment is debt with some kind of return there, and a portion of my investment is equity. We're coming in as equity owners.
Cal, it's just a quick question, and you don't have to dwell on this, but how often do you find, and certainly when you talk to entrepreneurs and family businesses and things like that, you mentioned about the ruling by intuition or making decisions by intuition. How often do you find an embracement and you put the check in the bank, and then suddenly they realize that they're not completely making decisions on their own, and that there's someone kind of looking over their shoulder. And my personal experience is you can sometimes get a rather violent reaction from owners who, they like the idea of the money, but not the idea of the control.
Yeah, it's an excellent comment, and we try to be very clear about that up front. So we've touched on that a little bit from, protections, a little bit from how much time we spend in advance of actually making that investment. Look, the CEO of Audacious Inquiry had never, it was kind of his brain and his sounding board as a partner. And that's where we spent a lot of time up front, which is, this is different, and we can go slowly, but like out of the gate, we think about the world as a independent governance structure.
Mhm.
And it is there to help you scale, because naturally it's not a bad thing for early days, but many founder CEOs, it's kind of that command and control, right? I've done everything in this organization, and naturally all major decisions need to come back through me, and I make the call. And that is not scalable.
Right.
And so that's a little bit why we do these personality assessments also, is just, do we have someone who understands, that the world's going to change, and the world's going to change. The company won't be successful if their mentality doesn't change on a handful of things. One is, how do I work and leverage with a board and think about, best practices, board governance. But also, if I can't let things go as a CEO, then I'm the bottleneck. And that, I think that's for where we get involved with companies is, and we spend so much time trying to help people, be set up for success in that regard. And it is, you need to start to think about really enhancing your level of trusted lieutenants. Not that you had a capable controller, but you can weigh in if you need to, and a capable development person, but you can weigh in if you need to. You need to think about it as, you don't need to be involved with every decision. You need to know what's going on in the organization, and you need to trust that there's people there who are dealing with the prioritizations of what you've tasked them with. And now you need to be thinking both externally and internally, and how do I best manage that people, and know, do I have the right person who's scalable as the head of my operations? Are we addressing the challenges we need in the flow over from marketing to sales? You're not tasked, CEO, with going and fixing it anymore. It's making sure you got the right people there to handle the situation.
Thank you.
So Cal, building on that concept you're just talking about, I'm very much involved with a family-owned business where the complexity and difficulty becomes exponential, where they believe someone in the family has to take the business over. The old succession planning process with tentacles on it. Have you encountered that kind of thing?
Yeah, and my usual reaction is, so we had we're I'm trying to think here before I can't think of a situation where we got involved with it getting passed from one generation to another. Maybe we were able to look at that next generation. I'm trying to think of an example or two where we said, this is a very capable leader, and maybe that transition's already started to happen. But we're really trying to back that leader of the organization. And if that, leader is, the mother of the family, and then says, well, this is going to be great, we're bringing you in, and here's my daughter who's going to take over the organization. That's probably not something that we're going to get involved in. I mean, I guess you could diligence it, but that sets, as you say, a whole set of dynamics that are difficult for us to manage. I had a healthcare business years and years ago that we were, I'd say probably, a month, 6 weeks into looking at, and I think we were beginning to form an assessment in our head of, the strengths and challenges we might have with the founder CEO. But we liked the business and we thought it was probably going to be a workable relationship. We went up to do a face-to-face meeting and got introduced to the son who was going to take over the business, which was all brand new news to us. And, this person was not of a skill set that we were going to back. And that was that. We just kind of walked away and on we went. So I'm sure people have been successful with that. I think as you say, it creates a whole host of challenges and going back to thinking about, are you thinking about the hat of the company or the hat of self-interest? And that sounds like a hat of self-interest of, I feel like the third generation needs to take over the business. That's fine. It's just, there are certain partners that may be comfortable backing that. We probably wouldn't.
Yeah, our board's struggling with that, and that's as far as I can, go with saying, but it's
Yeah.
a difficult one.
It is hard. And you could put it up as a little bit is kind of going back to that data, right? I mean, it's so what do we think the organization needs to do and look like and achieve, underneath the next leader? And we have small boards, so usually the board's involved in all this, but we do have nominating and governance committees and compensation committees and audit committees. And so what's the structure we're going to put around that? What are the characteristics we're looking for? What set of skills need to be, brought forward, and experiences need to be brought forward? And it's prudent to think about that as, getting yourself down to 3 to 5 candidates, right? That all could be legitimate opportunities. And if this individual is one of them, again, it's going back to a board that's making a decision, not a founder owner trying to pass it along in the family. So that's easier said than done, but
that's what we as a board are trying to do right now, is present alternatives. So that it's not just when the owner, it happens to be the mother, is looking at her offspring as possibilities when the board feels we need to move in a different direction.
Yeah. And if you have that kind of agreed to framework and characteristics, the data probably gets you to the right answer.
Thank you.
Yeah, Cal, on that point, or sort of on that point, when you're doing your personality assessments, is it kind of a binary thing, black and white, like you either passed or you failed, or is it one data point of many where you might say, well, this person needs some work, maybe we'll go out third party and get someone to coach them to get them to the spot where we need them to be?
Yeah, it's a great question. So as I said earlier, we don't do it as a go, no go. I mean, I guess we could have a situation where, we've been down the road with someone who we feel like we're having alignment and everything else, and we get back, some assessment that says do not recommend, in which case, maybe we got to think about the world again. But it's really, look, individual, you've built a $15 or $20 million business. I mean, it's a good business, and you've clearly had characteristics that have allowed you to do that. But we are going into a different framework of governance and leadership, and so it will help us collectively to know, what capabilities do you bring to bear? What are areas that we'd want to continue to build around you to have you set up for success around your ELT? Do we have a lot of hunters out there, but not people thinking about the organization? Do we have, a lot of people are very operations intensive, but we're just not getting the go-to-market right? So it's really about a communication style and how do people process information? Like, so, for me, I like to take a bunch of information in, and I got to spend time kind of kicking it around in my head. I'm not great at the, trader reaction. This happened. What are you going to do? I don't like to make decisions that way. I've had people who are very successful at making decisions that way. But if I'm dealing with someone who likes to make snap decisions with 60% of the information, while I'm sitting there saying, boy, I'd really like to sit back and let's get some input here and let's get some input there and think about it. We should know that we think about the world that way, right? And we should know, okay, so what does that mean for communication? Where are you going to be aware that I think about processing decisions different than you might? And that doesn't mean I'm right or wrong, or you're right and wrong. It's just, let's be aware that that's how, when we're talking about new things we want to address in the organization, what our natural inclination is going to be to attack that problem. And let's just have that on the table. So we don't have, kind of a miscommunication or feel like there's friction there that's being caused just because we've got a different way of processing information.
Thanks.
I'm just curious, Cal, what particular tool or tools do you use for those assessments?
So we're using third-party, folks. GH Smart is one of the groups. Summit's one of the groups. There's a lot of very capable people who have
Sure.
gone back and done their own science there. But
Appreciate
it's
it.
often focused on the CEO or the leader, and it's not just a data point or what you might get back from the Myers-Briggs. These are 5 to 6 hours of kind of interviews and questions, and it really does come back with a very thoughtful, this is how the person reacts in different situations. This is how the person processes decision-making. This is how the person thinks about, building capabilities around that individual. And we'll share it all back. I mean, it's not meant to be a gotcha or anything else. It's just, hey, we're, even though we spent a bunch of time together, we want this to be as efficient as a dialogue and relationship going forward. So let's just know, where can we best optimize around you as an individual to make you as successful as possible and not have unnecessary friction or communication issues at the board level, because in theory we should all be rowing in the same direction here.
All right. Well, Cal, thank you so much. It's we're a few
thank you,
minutes
everyone.
past. We really appreciate you having you on here. Great job. We hope you'll join us again at some point in the future, but we really enjoyed having you here. Mick, thank you for connecting us to Cal.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.